Hi, it's David Roach, Quantum Economics and Independent Strategy. I hope you're doing well wherever you are and whatever you're at and whoever you are. This is the second part of two videos dealing with events in the world and within China, which have political and economic implications for both. The first I discussed was the AUKUS deal between Australia, the UK, and the US to supply nuclear powered submarines of a non-ballistic sort to Australia, and how that shifted the global balance of power, raised the economic costs to China of its current external policies, and probably led to a breakdown in trust of the United States by the European Union partners. This now is a different topic. We are going to discuss the collapse of Evergrande and the real estate sector, particularly the developers, in China. Now, Evergrande is a company which cannot pay its debts. I don't have to run you through the detailed arithmetic, but it has no cash flow. Its assets are worth a fraction of its debts, and its equity is long gone. So it is a question of time before the corpse gets buried, but it is not a question of time as to when it is declared dead. It is dead. This matters in several ways. Evergrande, in many ways, is a microcosm of the Chinese macrocosm of over-leverage and unproductive investment. Basically, Evergrande should never have been allowed to get into the condition that it is in. But it is not alone. The entire real estate China model was based upon the acquisition of land at inflated values from local government, financing it with unstinted loans and credit by state-controlled, in one form or another, banks, and selling it on at equally inflated prices to the unfortunate individual investor who wished to live in it, or speculators who did not, but thought that the prices would go up further. That was the model. It was a non-productive use of capital, which actually siphoned immense amounts of capital away from more productive sectors in China, like small and medium-sized enterprises and indeed bigger technology companies. But that is a question of history. Where we are today is we have a perfect quantum economics disruptive event. As you know, what quantum economics says is that forecasts, macro forecasts, derived from big steady variables like, for example, interest rates, fiscal policy, inflation, resulting in market forecasts, which, if the trend is your friend, may possibly make you some money, but will never be right because the forecasts work. The disruptive events occur within the tiny cells which make up the macro forecasts. These cells are thousands of different causes, but what causes them to make a crisis is when one or more of them disrupts and blows out of all statistical, probabilistic, anticipated ranges. When that happens, the entire logic of the consensus forecast quilt falls to bits. And that is precisely what is happening in China. We all knew, and the big banks told us it didn't really matter, that China was over-leveraged. But it was okay, they said, because people always make money, and because there are 1.4 billion Chinese, and they always want to have more, and because China is master of its own leverage. In other words, the government controlled the banks. If the banks got into trouble, the government controlled the asset management corporation, which took over the bad loans. And the government, in normal circumstances, made sure that all the bank lending went to state-owned enterprises, which they own too. So generally, people said, well, you know, the fact that China is over-leveraged is a known. it won't surprise us. Well, now it's got to surprise us. It's got to surprise us in a classic quantum economical disruptive event, which then destroys all the parameters of comfortable consensus forecasts. Let's look at the size of the problem. Over 40% of total bank lending in China is connected to real estate. At a rough estimate, I put that at between 18 and 20 trillion renminbi. Of that, approximately 20% is bad. So we're talking at over 100% of GDP, of which in terms of loans to real estate companies of one sort or another, and probably about 20% of that is dodgy. In the case of Evergrande, which is just one out of 5 to 7 real estate companies, which I would rate as being probably in more or less the same condition, though in most cases not quite as extreme. Evergrande owes $300 billion. I actually think it's higher than that because a certain amount of debt disappeared off the balance sheet recently. And normally that's the story of corruption and hiding things, which goes together with subsequent bankruptcy, which we all know from our Western experience, and China is no exception. But call it 300 billion. Okay, so that is just quite a lot because it is about 1.7% to 2%, if you take my higher estimate of GDP in China. It is not too big to fail, Evergrande, but it is too big to ignore. So whether they like it or not, the authorities are going to have to step in and ring fence it. Now, what would that mean? It will mean basically that the assets are sold off, devalued and sold off to better quality real estate companies or individuals, that state-owned enterprises pick up some of the assets, possibly not the best ones, and that the banks have to eat their loans, probably taking haircuts of between 50 and 70%, my prejudice being closer to 70%, with the balance being repaid back on the never, because the bad loans will then be shunted into an asset management company under the control of the state, and they will be paid off perhaps when everybody has forgotten about them. There's a long precedent of doing that in China. That's fine. But there are two costs involved in doing this. But doing it is necessary, because by doing it, you will ultimately ring fence the problem and prevent a systemic collapse in China's debt mountains. That systemic collapse is being forecast left, right, and center now by the very same institutions who once upon a time said this was a known known, it's okay, it can be managed domestically. So I come out now on a more optimistic side than all the people who were more optimistic for a very long time. I think it can be addressed and contained, but there are costs, short-term and long-term, and I want to go through these. First of all, it's going to reduce GDP growth to nothing or zilch, and any positive sign will be the result of massaging the figures for domestic political reasons. The hits to growth will come from housing, where I would say that construction of housing will probably fall by about 20% at the best and could be 30%. It will come from the consumer, because the consumer has actually been putting money into these real estate companies in order to make a down payment on his house or her house. And of course, as the suppliers won't supply the real estate companies anymore because they can't get paid, then the houses can't get built and the consumer cannot get his house. Now that is where the big political risk is. President Xi and the Chinese administration cannot afford the dissatisfaction about losing your savings when you've made an honest payment to buy a house, that could spiral out of control. They're not going to let that happen. So come hell or high water, and it may be hell, the promises to deliver houses are going to be made true, and the consumer is going to have to be made whole. Banks, of course, are another source of the recession, which is now going to happen. And remember, a recession in China is anywhere below 6%, and I am talking about 0% for several quarters. The reason the banks are a part of this is because they're not going to be lending. Certain of them, and I can't manage individual names, are going to really need recapitalization. But in general, the big banks can get through. But of course, the reaction of bankers who are, if you take an image, their heads are screwed on backwards. They're always looking backwards, and their ability to look forward is quite limited. So the bankers looking back at a crisis always rein in credit, and that reins in liquidity. Means the PBOC has to intervene, which it is already doing, supplying more liquidity. But more importantly, it raises the question of whether loans will be made to productive sectors during this period. They will certainly not be made to housing. And that of itself pushes the Chinese economy towards 0% growth. And finally, of course, the households, the consumer, to return to them for a second, they have been the fastest growing sector of Chinese credit demand. It used to be 2% of total loans. Now, loans to consumers are around 136% of disposable income, which is higher than in the United States, which is hardly a virtuous model. And of course, those loans to Chinese households are much more expensive because Chinese interest rates are real. They're not a fiction created by the Fed to run below inflation. Chinese interest rates being real, the very high level of consumer debt, household debt, is a real cost, and it will hit confidence for two reasons. Number one, I don't think the banks will be lending very much. And number two, many of these consumers will be in a panic about buying a house or having tried to buy a house and not got its money or its house. So that's the picture for the immediate hit to growth. The biggest story is, however, not that, which China can survive and will survive without collapsing in a heap. So the doomsayers will be proved wrong in that. The biggest story is that the behavior of companies like Evergrande, and I could certainly put up about 7 more, but we've got to remember this is 18.6 or 19 or 20 trillion worth of borrowing from the banks and through bond markets. The biggest cost is that the government absolutely hates this sort of business. This is a robber baron business. It results in individuals getting astronomically wealthy by reaping economic rents. Economic rents is when you get paid, but you don't earn. So you're paid beyond anything you produce. This is precisely the area of capitalism of which the Chinese authorities have been battling for well over a year. It's the Alibaba story, it's the fintech story. Of course, it translated later into a data story and into a fairness in many other sectors for the consumer story, such as education, to reduce its cost. But in this particular case, it touches at the very core of what President Xi Jinping has now proposed, which is prosperity for all. It is, in a sense, the shared prosperity, the common prosperity, as it is called in the current Xi Jinping thought. Common prosperity. Don't forget it, because if you invest in China, that has to be central to your television screen. Common prosperity. It will be achieved despite its economic costs. What this means is that going forward, housing will be for the people. and houses will be for living in. Speculation, reaping economic rents from the level of the provider of the land, the local government, to the exploitational real estate developer and constructors, all of those will be under such a tight regulatory rein. They will still have to produce housing, but socially affordable housing, and they will do so at margins which must, going forward, be at least half of what they are. Now, that brings me to Hong Kong. Hong Kong, of course, has had the rule of law and commercial law, the law of tort contract, enforced for many years. So we're not talking about civic society, and we're not talking about the independence of the judiciary. That's another topic altogether. We're talking about how people did business here. The British made the laws and the Chinese made the money. A happy colonial relationship in some respects. However, it meant that the Hong Kong tycoons became abnormally rich. They reaped the same economic rents we are now seeing problems with in China. And they will, and the Hong Kong property market will, have to conform with President Xi Jinping's ideology of common prosperity, which, when it comes to housing, means houses for the people, costs that are reasonable, and no more economic rents. That is why I would issue 2 words of warning to investors. Number 1, if you own bonds or other forms of debt in the Chinese mainland or Hong Kong real estate sectors, get rid of them. And in the case of Evergrande, where 20 billion is owed to foreign investors of the 300 billion US dollars I started by quoting, you're not going to get a penny back. Domestic bondholders may get 30, at very best 50% of their investment back, but you as a foreigner, you will get nothing. Secondly, if you are investing in China, you have to pay attention and keep a focus on common prosperity. It is a plate shift, ideological change, almost as big as Maoism itself. And it is a reorienting of the Chinese economy to serving people rather than letting a few people get rich in the hope that the trickle-down effects will benefit everybody. That period, the equivalent of the robber baron period in US history, is over. And finally, Hong Kong is a part of China. I don't think many people need to be reminded of that today. But people seem to think that the culture of Chinese tycoons being fed cheap land by the government, inflating the prices that it constructs, the costs for construction, and selling inflated flats and apartments to individuals who are then financed by mortgages for 30 years of the rest of their lives from banks who don't even take any risk on the interest rate because it's variable. That comfortable paradigm, which was the way that Beijing ensured that the tycoons who were dominant in the political system would consistently serve the interests of Beijing, that is over. Beijing does not need the tycoons here to rule Hong Kong. Beijing does not need to pay tycoons economic rents in order for them to be quiescent or pro-Beijing. And that means that if you take the average margin on a Hong Kong real estate developer divide it by 2, and increase the discount factor by 2 to reflect forward-going economic and political risk, and then revalue the price. And I would bet my bottom dollar that you will not be a big investor in Hong Kong real estate anytime soon. Goodbye, good night, and don't turn off the lights.